Hey everyone, Akasha here, and today we're diving into something that I genuinely believe is going to reshape every single financial transaction you make for the rest of your life. Central Bank Digital Currencies, CBDCs. Now, I know what some of you are thinking. Akasha, isn't this just like crypto? Isn't this just a Bitcoin thing? And I have to stop you right there, because this is actually almost the complete opposite of what Bitcoin was designed to be. Grab your coffee, settle in, because this one is going to challenge some assumptions. I remember sitting on a trading floor back in 2015, and a colleague of mine, brilliant guy, 20 years in the game, lit a research note across the desk about digital payment infrastructure. He said, Akasha, in 10 years, the way governments think about money is going to fundamentally break. I laughed it off. I should not have laughed it off, because here we are, and central banks representing over 98% of global GDP are actively exploring or already piloting their own digital currencies. That is not a fringe conversation anymore. That is the conversation. So let's start from the ground up. A central bank digital currency is essentially a digital form of a country's official currency, issued and regulated directly by that nation's central bank. Think of it like this, right now, the dollars in your bank account are digital already in a sense, right? You see numbers on a screen. But those numbers represent a liability of your commercial bank, not the Federal Reserve itself. A CBDC would be a direct digital liability of the central bank. It's the difference between holding a gift card from a store versus holding actual cash from the government's vault. The Bank for International Settlements, the BIS, which is essentially the central bank of central banks, published data showing that as of 2023, 130 countries were exploring CBDCs, representing 98% of global GDP. 3 years prior, that number was only 35. The acceleration here is stunning. China has already launched its digital yuan, officially called the ECNY, and they've processed over 250 billion yuan in transactions through pilot programs across major cities like Shanghai, Beijing, and Shenzhen. The European Central Bank is deep into its digital euro project, with a formal investigation phase that wraps up and moves toward potential issuance. The Federal Reserve has been more cautious, very on-brand for the Fed, but they released their discussion paper on a potential digital dollar and have been running experiments through the Boston Fed's Project Hamilton in partnership with MIT. Now here's where it gets interesting, because the motivations behind CBDCs are layered, and they're not all the warm and fuzzy financial inclusion story you'll hear in the press releases. Let me break down both sides honestly, because that's what you come here for. The stated benefits are genuinely compelling. Financial inclusion is a real issue. The FDIC reported that about 4.5% of U.S. households, roughly 5.9 million families, remain unbanked. A CBDC could theoretically give anyone with a smartphone direct access to the financial system without needing a traditional bank account. That matters enormously. Additionally, cross-border payments are currently slow and expensive. The World Bank estimates that the average cost of sending remittances globally is around 6.2%, which is crushing for families sending money back home. A CBDC infrastructure could slash that dramatically. Then there's the monetary policy angle. CBDCs give central banks extraordinary new tools. Imagine being able to implement negative interest rates that actually work right now. If the Fed goes negative, you just pull cash out of the bank. With a CBDC, there's nowhere to hide. They could also implement programmable stimulus payments that expire if not spent, essentially forcing economic velocity. During COVID, the stimulus checks took weeks to distribute. A CBDC could have done that in minutes, and they could have targeted exactly who received it. But here's where I need to get real with you, and this is the part that kept me up at night when I really started researching this deeply. The surveillance potential of a CBDC is genuinely unprecedented in the history of money. And I'm not saying this as a conspiracy theorist, I'm saying this as someone who spent years analyzing financial systems and regulatory frameworks. Cash is anonymous. When you buy a coffee with a $5 bill, nobody records that transaction in a government database. A CBDC is, by its very nature, a fully traceable, programmable form of money. Every transaction, every purchase, every transfer could be visible to the issuing authority. And before you say, well, credit cards are already tracked, understand the distinction. Credit card data is held by private companies with legal barriers to government access. A CBDC could be architected with direct government visibility built in from day one. China's ECNY is the case study everyone should be watching closely. The People's Bank of China has been explicit that the digital yuan is controllable anonymity, which is kind of a fascinating phrase if you think about it, because controllable anonymity is not really anonymity. Reports from the Wall Street Journal and various financial research groups have documented how the system gives authorities transactional visibility that simply didn't exist with physical cash. The American privacy debate is going to be fierce. Senator Tom Cotton and Congressman Tom Emmer have already introduced legislation to restrict a Federal Reserve retail CBDC specifically over privacy concerns. This is a genuinely bipartisan anxiety, which tells you something about how significant it is. Now let me put my analyst hat back on, because if you're thinking about portfolios and market implications, CBDCs create some fascinating dynamics. The big question for commercial banks is what happens to deposits. If people can hold money directly with the Federal Reserve through a digital dollar, why would you keep it at JP Morgan Chase or Bank of America? This is what economists call disintermediation, and it's a genuine existential question for retail banking as we know it. The Federal Reserve itself has acknowledged this tension. In their research papers, they've discussed potential design choices like holding limits or non-interest-bearing features specifically to prevent CBDCs from pulling deposits away from commercial banks in a destabilizing way. So you'd likely see a CBDC designed to coexist with the banking system rather than replace it. At least that's the political reality in a country where Wall Street still has significant influence over regulatory design. I saw that dynamic play out so many times from the inside. Payment processors are another interesting space to watch. Companies like Visa and MasterCard have actually been proactive about positioning themselves as infrastructure layers for CBDC implementation. Smart move. If you can't beat the government's money, become the rails it runs on. Meanwhile, PayPal and Stripe are watching this very closely because their core value proposition shifts significantly in a CBDC world. This is bigger than any one country's financial policy. We are in an active geopolitical competition over whose digital currency becomes the global reserve infrastructure. The dollar's status as the world's reserve currency is one of America's most powerful economic advantages. It's why the U.S. can run deficits that would cripple other nations. China is openly attempting to use the ECNY to create dollar-independent payment corridors, particularly across Belt and Road Initiative countries. Russia has launched its own digital ruble pilot. The implications for dollar hegemony over the next 20 years could be massive. The Atlantic Council's CBDC tracker, which I check almost obsessively if I'm being honest, shows that 11 countries have fully launched CBDCs, including Jamaica with its JAM-DEX and Nigeria's eNaira. These early movers are the test cases everyone is learning from, and so far the adoption curves have been underwhelming, which suggests that the technology itself is only part of the equation. Trust and habit are the harder problems. So where does this leave us? CBDCs are coming. Not as a maybe, not as a distant possibility, but as an active, accelerating global development. The question isn't whether they'll exist, it's what design choices get made, what privacy protections get built in or left out, and whether citizens actually have a voice in shaping the money of their future. My honest take? I think a well-designed CBDC with strong privacy architecture and clear legislative guardrails could genuinely modernize financial infrastructure in meaningful ways. But I also think the risks of getting this wrong, of building a surveillance layer into the foundation of money itself, are serious enough that we should all be paying close attention and demanding transparency from the institutions designing these systems. This isn't a topic you can afford to leave to the technocrats. Do your research, follow the BIS publications, watch what China's pilot data actually shows, and pay attention to the legislation moving through Congress. Your money, your future, your voice in this conversation. Let me know what you think in the comments below.